Our second speaker is Bill Jump. He's a member of our AAI board in Silicon Valley and has done a number of presentations on energy and other subjects. He's prepared a presentation on assessment of the Russian invasion of Ukraine. And I've gone through all the slides. There's some great material here. And Bill will be stopping at certain points and asking for questions as he goes through segments of the presentation. So Bill is a retired IBM engineer and manager, has many, many years experience investing, and has a really good handle on how it works, what goes on, and just the general philosophy of how to execute an investment strategy. And he's done a lot of analysis in his job in the past. So Bill, it's forum is yours.
Okay, can everyone hear me? Can you hear me, Deborah? Celia?
Yes, I can hear you. And
Okay.
Yes.
it
Great.
says you're
Great. So what you'll see in my presentation is I'm trying to capture a lot of real-time events that give me clues to the future. First, I'll cover the war, and I'll skip over some of that fairly quickly, but I want to get to the investing part. And so what I've done here is I've broken the pitch into about 4 areas. We'll cover the war and some data from it. That'll take us to the end of slide 17. I'll take some questions at that point. Then I'll go into what's this mean for Europe? And that'll take us to slide 30. I'll take some questions there. Deborah, if you'd be kind enough to capture those, I'd appreciate it. Then I'll go into our economy, the signals that the bond market is sending to us, and that'll take us to slide 43. Then I'll go into the Fed, the yield curve, and markets. And I will end on fundamentally on slide 57, where I talk about my tickers. You'll see what I own and why. So here we go. This slide says, you're not going to sue me or the or the association. This is not investment advice. It's information, personal opinion of my capture of what's going on. So, it's just garden variety, common sense. So here's an outline of my pitch. I'm going to cover the war, some data on Putin, sanctions, peace talks. Look at the risk of loss as a result of the war, and in particular exports from Russia and Ukraine, the impact on Europe. I'll touch on oil and natural gas and the US investing outlook. I've got heat maps on returns. I'll cover US oil, fixed income, and commodities. I've got a lot of thoughts on market outlook and pressures. Go over the Fed, inflation, US Treasury rate inversion, potential for stagflation, and the balance sheet runoff. That's a really big deal. I'll do a snapshot on the Callan table. Jim had a version of that, which is from Morningstar. I use the raw Callan table. That is a excellent reminder about diversification. Where are we in the business cycle? And then a review of my tickers and a quick summary. So here's what I see of the key issues that we have in 2022 in investing. First, we've got the war and its fallout. We really don't know where this is headed. We don't know the ultimate resolution, whether it's protracted war, a stalemate that results in peace, a meaningful peace talk, or what, or an expansion of the war. We really don't know. So that's a major unknown. We've got inflation, commodities in general, supply chain, we've got oil, food, etc. The Fed's response is going to be quite aggressive in fighting inflation. They've been signaling that through their rhetoric. We've got earnings. Earnings, I want to point out, are looking backwards. I focus on guidance. When an earnings report comes out, they talk about what do they see looking forward in the face of inflation and their own business opportunities. As an example, Home Depot will cover what they see in the home market, home builders market. And so there's a lot of value if you're looking at individual stocks, or even if you're an indexer, to take some time and read the earnings call slides that cover guidance of individual stocks, because it'll give you tremendous clues as to what CEOs see looking at their own businesses and associated and related businesses. So looking forward is what the clue to what the market's going to be doing, as opposed to looking in the rearview mirror. COVID, BA2 variant is now the dominant US variant. We've gone through BA1, BA2, they're less impactful, but now, and I will cover this later, there's a new variant you haven't heard about yet, but I will explain it. And lastly, a really big thing, even if the war comes to an end, sanctions on Russia are likely to stay in place. So that's going to be an enduring, for some period of time, positive in some areas and negative in others. So those are the main issues as I see them. Okay, the war issue. You all know that happened on the 24th of February. And we really don't know where Putin's going to stop. The good news is that the Ukrainians have shown a lot of backbone and have pushed them back with our help and the help of other folks around the world. Troops have been massing for some months prior, so we shouldn't be surprised that the war started. We just didn't know when. Zelensky, the president, as you might know, has been all over the globe soliciting help. He even showed up at the Grammys. And God bless him for pushing Putin back. But a human toll is terrible. Now, why is Putin invaded? Last summer, he produced a 5,000-word essay, no doubt with help, but it said he wanted to restore Russia to its former Soviet Union status, which, by the way, includes some NATO countries, some countries down in the Middle East, I call them the stand countries like Kazakhstan. And he's got an objective in UKR that's well stated. He wants a complete surrender, takeover, and a Russian-friendly government. So far, he's not been successful. We'll see what happens. Now, the 5,000-word epistle clearly outlines that what his objectives are. And there's some, it's been taken down from the web, but Wiki has a description of the content, and you can find that on Wikipedia. Here's some references. And he's clearly frustrated that he hadn't been able to achieve a 2-day takedown of Ukraine. Okay, here's his history. What I want to, you can read the top part, but what I really want to point out is that he has a history of censorship. He has absolute control of the military, the media, and he's got a history, well documented, of here's 6 examples of aggression, invasions, and his MO is to flatten cities, kill the citizenry, and try to get capitulation. He's been poking on Ukraine since 2014, up till now and continuing. And here's a list of what he's tried to do since he took power in 1999. Okay, you've seen a map of Ukraine. Just a reference, you know that in the capital is up near Belarus. What I want to point out about Belarus is that's a Russian haven. It's a very Russian friendly government. So Russia surrounds 2/3 of Ukraine. So Kyiv's not very far from the border. And by the way, Chernobyl is right up against the border. And so this is all a very dangerous area. Okay, so areas in contention. If you look at the southeastern part, it's called the Donbass region of Ukraine. This thing started when he recognized the Donetsk and Luhansk regions as being independent, and ordered Russian troops to go in and quote unquote keep the peace. On the right side, you'll see where his the first part of that lower right-hand slide shows where his permanent armament stations are, and then shows the red dots, the buildup of troops just for the leading to the invasion. So it's very clear he had something bad on his mind. Okay, Ukraine and Western Europe. Now the significance of this is just to point out that just to the west of Ukraine, we have NATO countries. So if he's not stopped there, who knows what he'll do. And if we get embroiled in a war, you know, NATO Article 5 would, a breach of that would involve us and be potentially a very bad situation with respect to World War. Okay, sanctions. The summary is they've been applied, but they never deterred the invasion. And the administration touted these as a deterrent, but it hasn't worked out that way, but it's going to be and is an effective form of punishment. So what Ukraine really needs is some big military arms. And I was very pleased that yesterday, you may have heard of the S-300 missile defense system. That's actually a Russian-built system. And one of the Slovak countries to the west finally agreed to give Zelensky some better air defense in the form of the S-300, which will allow them to hopefully stop the firing of missiles from Russian soil on the east of Ukraine. So that's good news. Okay, peace talks. We've had a series. I don't see anything coming out of this unless there's capitulation, and I think both sides are dug in. So this could go into a stalemate, and that's actually what I think will happen, a prolonged situation of terrible war. Here's the the economic outlook. First of all, Russia is listed either 10th or 11th in most GDP ranks. Ukraine is about number 55. They will both be certain to fall in their rank. Russia, of course, is in an entirely different situation. They're being isolated, so their export capability is blooded. But in the meantime, the devastation in Ukraine is very significant. The town of, I'll try to pronounce it, Mariupol, which is in the southeast, has utterly been destroyed. 90% of the buildings are in rubble, and at some point, I hope the people can come back and rebuild. But their export capability is in the toilet for now. Now, what are we doing to support? First of all, humanitarian support, and it's coming from all over the world. Refugees of 4 million, probably more now, have moved about half to Poland, and then the other couple million have, excuse me, have fled to other countries in the area. U.S. has announced plan to accept 100,000 refugees, and by the way, they're now showing up at the southern border. So they will be seeking safe havens wherever they can. And of course, it's primarily women and children, because men 18 to 60 were mandated to stay at home and fight the war. So family separation here is a real tragedy. And I'm sure we're all hopeful that there can be a reuniting of families. So I would encourage all to give generously to the many charities that are trying to support the people. From a military standpoint, we've given them javelins, which are portable heat-seeking missiles, and they've taken out a lot of tanks and armored vehicles, and even some helicopters. Then there's a Stinger's 4,800 kilometer range, heat-seeking anti-air missiles. And the administration went silent on this. Not sure why, but they admitted to it, and then so we don't really know what's being provided there. Munitions and gear, and we've got a lot of additional troops that have been sent to NATO and are in the Eastern Bloc up against Ukraine, helping NATO train and be ready for an adverse event if it happens. The Eastern Bloc countries are also adding 4 new army divisions. Germany and others have woken up, and they're adding now to their defense budgets. You may recall that Trump nagged them about paying their obligation of 2% of their GDP. So there will be, now there's an awakening, and there now be an investment in European defense, both the US, Germany, for example, is planning to buy Lockheed 35 attack fighters. And of course, the French have fighters, as does the UK. And so I'll talk about defense spending at the end. Turkey supporting them with drones, and the cries for MiG fighters have been dismissed, and the reason was a risk of provoking Putin into being more aggressive and leading potentially to additional conflict. Now, the S-300 air defense system, that was resolved yesterday. But I think overall, its support could have been much more substantial and faster, and should have been provided before the attack. Okay, here's a website that I really like when it comes to commodities. It's it's called OEC. It's the Observatory of Economic Complexity, and they have a lot of information. In this case, I'm showing a heat map of the key Russian exports: oil, natural gas, grains, metals. And because of the sanctions, they're going to be stymied, and there will be shortages. Example, oil is going to be, some amount will be taken off the market. A reasonable estimate is 3 million barrels a day. So that is a upward pressure that's already been realized to some degree in the price of oil. Now $100 for domestic oil and about 109, I think, for Brent. So you can see that they export crude petroleum, refined petroleum, other major commodities, gold 4.25, coal briquettes, you see. So they've also got a major source of palladium, which we use for catalytic converters in automobiles, and they're a major producer of aluminum. Now, here is one way you can use this site. If you want to know about a particular commodity, you hover your cursor over that block. And in this case, it tells you that Russia's refined export value is 66, I think that's it, 56 billion in value, and it's 16.3% of their export value. Down in the lower corner, right-hand corner, you see that the United States was importing 7.32% of imports from Russia. 2 years ago in the Trump administration, that number was right around 3%. And I thought that, well, we just started buying Russian oil. Well, the fact is, we've been buying Russian oil for quite a long time. We're just have been buying more recently. So this is a useful site. Unfortunately, there's a lot of areas where there's small exports that might be meaningful that are hard to get out of this site. Now here's a view of Ukraine, same kind of thing. And I've shown here, we've got the wheat area noted, 6% plus, and though the planting season is really in turmoil. You can imagine trying to plant when fertilizers come from Russia. There's a war going on, and it's going to cause a huge problem with foodstuffs, particularly in the Middle East and Eastern Europe. So it's going to have a lot of ramifications. Now, on the right side, you see imports, what Germany takes, Russia takes, Italy, Spain, China, India, Turkey, etc. Now, just 2 days ago, VW announced, and BMW as well, they had sourced wiring harnesses for their automobile production from Ukraine. Well, guess what? They're now in dire straits because they've shut down their factories. They've got to go do find new vendors. There's lead time in getting new vendor up and running, having the parts. So there's going to be a lot of surprises come out of this that as people run out of critical parts will be announcing. And I think the supply chain in some areas is going to be a problem. Now, neon is used in semiconductor production, and it's used to squelch oxidation as they etch the semiconductors. Turns out that Ukraine has two of the world's largest suppliers. They account for 50% of worldwide neon production. One of them's in Mariupol, which, as I previously mentioned, is been highly shelled. The other one is in Odessa, which is in the south. And so some manufacturers had previously gone to an alternate material from gas from neon, but not many. And so depending on the supply of individual semiconductor manufacturers, they may run out. There'll be a run on supply, prices will go up, and it'll be an impediment at some point down the road unless this gets turned around. Okay, there's also this risk with agriculture. A week ago, the Ukraine Interior Minister reported that he was going to have a supply problem. He expected to lose at least half of production. Countries at war, they're having a hard time planning. They depend on Russia for fertilizer. You can see that's over with for now. And port access, I can imagine they've got grain silos. The only route now is to go by rail instead of sea, and they got to go through the Eastern Bloc countries. So, excuse me, shortages are probably going to cause famine in some areas in the Middle East. Key crops, they've got wheat, corn, barley, rapeseed. If you fly over the UK and you look down, you wonder what those beautiful golden colored fields are. That's rapeseed. It's a key source of protein. Canola oil is made from it. It's a very large worldwide crop there. And also, just yesterday, I heard they have a large supply of sunflower seeds. So there will be a shortage of vegetable oil. in the world. Now, from a wheat standpoint, the grain standpoint, we've got good supply in the US and Canada, but costs will be up. You know about inflation. So I'll take any questions.
Please enter questions into the chat.
Okay, we'll move on. So my view of Europe is it's difficult to invest in now. They've got the war on their mind. They're getting ready to invest more in defense. There are shortages. They have dependence on Russian energy. And I learned a lot about Europe in 1977 when I had an assignment in Stockholm, Sweden. And I learned very crisply about the national culture attitudes, I'll call it. Even though there's been more multiculturalization of the continent, there's some really deep-seated feelings based on World War I, World War II. And so cooperation is, let's say, stretched at times. Also, they're a slow growth economy. They're cyclical. There's limited technology. We have the blessing of secular growth from our great companies, many of which are here in Silicon Valley. They've also got to absorb all these immigrants. They just went through Brexit, and so they're going through the growing pains of that. Also, the ECB is not like our Federal Reserve. They don't control individual country rates, and they have limited powers. Now, the positive side, they have, you invest in Europe, you've got a much higher dividend rate, but they're usually semi-annual. And they're hard to invest directly at a retail level. You got to have, you're either in a fund, an ETF, or an ADR. It's very difficult to go after individual countries at a retail level from US brokerage. And of course, they're a very large trading block. That's a positive. Now, what's happening with inflation there? Well, they've got a natural gas emergency. Germany declared this March 30th. There's no rationing yet. There's an issue on cost and payment. The contracts are in euros. Putin wants rubles. It should be easing up now because it's starting to warm up. But as we get into next winter, if things aren't resolved, he could weaponize this. There's a chart on the right of the producer PPI in Germany, and you can see it's up 26% for February. The Dutch natural gas contract for February was $119. US natural gas was about, I think, about $3.50 a year ago. Now it's 5 to 6. But you see a huge disparity between what's happening here and there in terms of prices paid for energy. And I have a daughter that's living in just south of Bonn, Germany. And so I've got a real-time contact with what's going on there. Okay, here's the natural gas pipelines of Europe and a heavy dependency on Russia. If you recall, in the Trump administration, Merkel, Chancellor of Germany, was negotiating with the Germans on a new pipeline called Nord Stream 2. That's that pipeline in yellow that runs down the Baltic Sea between the Baltic states and Sweden down into Germany. Trump implored them to cancel that and take US natural gas. They ignored that. And now they're very dependent on Russian gas. Well, they've canceled the project and we've promised to supply them, but they don't have the ports. And most of our natural gas, Schneider Energy, for example, ticker LNG, is sold out for some time. Now, what they've done to alleviate the problem is they've diverted shipments from Japan and points in Asia to redeploy them over to Europe. So now they also shut down, Germany did, shut down their reactors after the Fukushima incident, and they bet the house on renewables and Russia. But now Russia's cut off. So there's a real serious problem with energy in Europe. Now, in my career in IBM, engineering and managing products, we designed to eliminate what's called a single point of failure. In other words, you want to have redundancy. But Germany went the other way, and they are now having to deal with a single point of failure. So we'll see how this works, but it's going to mean inflation in Europe for quite a while. Okay. Here's the top five oil producing countries, 1980 to 2020. The US, this is a graph of that 40-year period of time. US is now king of the mountain. You can see in the blue line that when fracking took off, we're producing over 11 million barrels of oil per day. But we consume 20% of the world supply. So we get some from Canada. Russia is about 10, but some of that's being taken off, and it looks like we'll be short 3 million barrels of Russian oil that'll be blocked, hard to replace. And the wild card is what happens with Iraq. The curious thing is Russia is our intermediary in negotiating a new nuclear pact with Iran. Now, how does that work? I'm not sure I get it, but turns out the Iraqis won't talk to our team, and so Russia was the intermediary. And if there is a deal, then Iraq will put oil on the market, which will partially relieve the problem. So we'll have to see how that turns out. The rest of the world, this is, I call it Asia, Oceana. That's Oceana is Australia, New Zealand, and comment on Latin America. Latin America has been the best producing world area in terms of investing this year. There's an ETF, ILF. There's other ways. You can go to EWZ, Brazil, or I think it's MWW is Mexico. Here's some market pressures. many tickers went into a bear market months ago. And what held the market up was our key stocks, Apple, Microsoft, etc. And so the fate of the market is to a large degree in the hands of the big stocks, but there's a tremendous amount of opportunities with battered stocks. As Jim said, you got to do your homework, but individual stocks present a better opportunity in my mind than an index at this point in time. Now, the Fed started to pivot in November, and this last week they really amped up the pressure with their rhetoric. We're going from quantitative easing to quantitative tightening, which means liquidity is coming out of the system, and that usually is not a good sign for markets, but I think that this has come on us so fast, we're not long, hopefully, from a bottom. The balance sheet reduction is a huge impact. I indicated no plan yet, but they have now indicated some level of detail that I've got on another chart, so I'll cover that. But they are signaling that they're going to be very aggressive. Administration has been, I think, unfriendly to business. They want to raise the corporate tax to 28%, currently at 21%. They've been especially harsh on energy, but now they want help. They're also seeking a 15% minimum tax on domestic companies plus international earnings. US multinationals have 50% of their revenue and profits from overseas. So companies that quote unquote don't pay tax are going to get hit if they're successful. Now, this hasn't been implemented yet. There's 136 countries that have signed up to do this. So we'll see whether this can pass muster or not. Inflation, we've had trouble with supply chains and shipping. It's starting to ease up now, but China's in lockdown. In Shanghai, they have a zero tolerance policy, so we'll see. Oil and foodstuffs are up. COVID, I'll have a comment on that. Labor and housing have gone through the roof, and war just aggravates it. And we have a risk of protracted hostilities and expansion. Now, with respect to COVID, you know about the Omicron BA2 and China lockdown, BA2 being more than 50% of US infections, but less infectious. But now I just discovered there's a new variant called XE. You probably haven't heard of it, but it's in some foreign countries and it's a cross of BA1 and 2. Looks like it's more aggressive from an infection standpoint, but not as lethal. So we'll be hearing about that as time goes by. Okay, I just love heat maps. Now here's a heat map of the S&P 500, a website called Finviz, which is a great financial website. At a glance, if you run this, this happened to be a year-to-date snapshot. What you can see in red is where stocks were down. This is a map of the individual stocks organized basically by industry or subsector. And you can see that over on the right, the only positive sectors were energy and utilities from the first quarter. If you look at the blue arrow I've got over on the right-hand side, if you run this through the day, you can do a year-to-date, or you can do a week or a month. And there's a tremendous amount of information throughout the site. You can search individual stocks, look at their charts, etc. So it's a fantastic website if you're into market watching. Here's a graph of the first quarter performance by sector. And again, you can see the outperformance of energy and utilities, and other sectors were basically down for the quarter. Another way to look at the market is an ETF heat map on Finviz. In this case, I've got my ticker, or my, excuse me, my, I've hovered over energy, and what it does, it pops up this box, and you can see all the tickers and their performance in the in that part of the investing package. So you can again select the time frame, you can hover over any area, and you get this key data. Here's a world heat map, same site. Again, this is a quarterly view, and the bigger the area, of course, the more prominent the investing area. So Canada is up in the upper left, way down in the lower right, you've got Australia. BHP, biggest ticker, is a miner, a material supplier. So tremendous amount of useful information to get a handle on what's going on. Okay, the oil price spike. First of all, the market is worldwide. It's priced in dollars. As the dollar goes up, you can buy more oil. So it's sensitive to supply, demand, and the US dollar. The two key benchmarks across the world are US WTI, that's West Texas Intermediate. Think of the Permian Basin that goes over into eastern part of New Mexico. And for international, it's North Sea Brent. Shorthand is Brent. The imports from Russia increased to 600,000 barrels a day. There have been 18 tankers at sea still coming to the US. So the ban that was imposed is not immediate. Europe, we talked about, very dependent on Russian oil, but there's no sanctions on the sale. But there's some self-sanctioning going on, meaning financing a shipload of Russian oil is getting more difficult because banks are afraid of being sanctioned. So there's, even though we're not sanctioning everything, banks and insurance companies are doing some of the job. China and India, others in the Middle East are buying Russian oil. They impact on price as they produce a supply-demand unbalance. Now we've got we had a small and now coming a big strategic petroleum reserve release in the US. It's not a fix. And I find it curious. The release runs right up against the midterm elections coming this fall. Now, on the positive side, it's very difficult to increase production. So other options are hard, and this hopefully will give some release on gas price. The administration's focus on renewables is really years away for adequate supply of solar, wind, whatever. Here in California, the plan, it's got to be passed through the legislature, is $400 for each of us for 2 cars. And I think they're even giving it to people without cars. So we'll see how this turns out. Now, the administration is begging for more production now, but the EPA has been slow walking permits. You've heard, well, there's 9,000 leases out there. They just have to go drill. Well, EPA is slow walking them. So supply is tight. We're just about to get to driving season. And the only relief I see is a possible Iran deal that will dramatically increase market supply. Here's a set of charts. The administration claims that all the inflation is caused by Putin and the war. Well, that's really not true. If you look at the 5-year futures, the day after Biden won the election, you see the little faint line, vertical lines. The day after the election, futures in oil went up, and they've been climbing ever since. And then over on the right-hand side of those graphs, you see this oil spike where oil spiked to 130 a barrel. It's now settled back. You know, the market tends to overcorrect, undercorrect, so overshoot, undershoot. So you got to be careful when things spike like that. Down at the bottom, I show the rig count in the US. Baker Hughes, which is a oil services company, publishes weekly a rig count of US and also worldwide. Rigs are how many are actively drilling for oil and natural gas. And if you look at this chart, in the last year, we've added almost 50% of oil rigs. So the administration's claim that the oil companies aren't doing, and Congress, aren't doing their job to help us is really not true. We've added 243 rigs in the last year through the end of last week. And last week, the oil executives were hauled up to Congress and grilled for being bad boys. But the fact is, they've been doing what they can. Remember, there are shortages in truck drivers. Truck drivers have to get fracking sand to the site. They've got to drill. They need pipe. It takes water. There's a lot that goes in, and you just can't snap your finger. And takes many months, particularly with supply shortages, to increase production. And with an administration that says, I'm going to kill fossil fuel, the producers are being very cautious about their long-term prospects. So here's a set of charts on the oil release, the history of it on the graph on the right, and on the lower, on the left, the lower right, you see the capacity over back since the 80s. Now, OPEC is a major factor in supplying oil. They have a plan to increase by 400,000 barrels of supply a month. In March, they added 432,000. They revisit this every month. And the SPR release that we're doing from our 4 sites in Texas and Louisiana could discourage additional supply increases, and also there are other countries planning to release oil. So this, as with everything else, we've got to stay and watch and see what happens. But the planned release is quite large, and I think it's a result of really having nowhere else to go. They had been courting the Saudis, who would not take Biden's phone call, and Venezuela and others to pump more, but that's been rejected. And with regard to Iran, their capacity's nearly 4 million barrels a day, so they'd have to ramp that up. I don't know if it could be done in time for summer driving or not. We'll see. Okay, any questions on that? Because I'm going to move into fixed income now.
There are questions in chat. The first is inflation effects and worldwide food inflation.
I have a chart on inflation, which is probably 10 minutes away. So, but the basic thing is food inflation is caused by fertilizer, trucking, shortages. Remember, we're coming off of COVID. There's a lag time. Not everybody's back to work. And so I've got a chart that shows the different areas of inflation and how much they've increased over the last year. So I'll come back to that.
Okay, the next question is, what is your opinion about the theory of the US dollar starting to lose its worldwide reserve currency status?
Well, China has ambitions on that, but the US dollar 2 days ago, for a short period of time, topped $100. So it's risen quite dramatically this year, over the last year. So it has enormous power. The only thing I think that would really threaten it is if we get into a situation where we lose control of our ability to pay our obligations on treasuries. But if you look at the only potential threat to that I see would be China. And China's got its own debt problem. They overbuilt over the last 20 years, and they've got all these ghost cities that are unpopulated. The other candidate would be the euro, and they've got problems too. So I certainly don't see that happening in my lifetime, and I think it's a low probability event.
Okay, next question. Are you tracking German defense companies? If so, what looks interesting to you?
Germany's light on defense companies. I would suggest look at the UK and France. France has some pretty good defense companies in the sense that they have great jets. And the UK also has good defense companies, BAC, I think it is. And but I'm not aware of any significant German defense countries per se. They're very
Companies.
industrialized, no question, but they've lagged on defense quite a bit. I don't think they even have a substantial army of any kind.
Okay, the last question in chat is it possible to elaborate on the vertical line that corresponds to Biden's election of his presidency?
Yeah, those charts are the futures charts. You can find it on the web. The futures charts are just what they say. They're an indication of the futures prices as opposed to spot prices. So the market reacted. After all, Biden, during his campaigning, said he was going to kill the oil industry, the fossil fuel industry. So having won the election, the markets reacted immediately to seeing higher oil prices because they were going to restrict activity of the oil producing companies. So that's right, right out of the, I think it's either CBOE or the CME exchanges. And that's driven by the market projections of what's going to happen. So futures aren't always right, but you could see from the chart, they kept going up, and in fact, we've had higher energy prices because it's a supply-demand equation, and commodities in general are boom bust.
Okay, there's one additional question that came in. Do you think that if oil prices spike above 150, Biden might use the Defense Production Act and force oil companies to produce more at a set price?
Well, I think he will, but if oil goes to 150, there'll be another thing happen. It's called demand destruction. Demand destruction is when the public says, I got a ration, I'm not going to spend that on travel, I'm not going to drive far, I will carpool, and the demand will go down, and oh, by the way, the Fed would react severely. So I don't see that happening unless we get into a war situation. Write down demand destruction.
All right, one additional question. What is the commodities website referenced earlier?
I've got a reference to that. I think I've got the ticker or the URL in my backup charts. It's called the, let me find the name, Observatory of Economic Complexity, OEC. So you'll find that in the backup. Anything else?
That's it, and I believe someone posted the link for that.
Okay, so I'm ready to go into fixed income. What does it mean for bonds, and what is it telling us about the market? Fixed income, caution, the bond bull market is likely over. If you go back through history and look at bonds and inflation, you know, when Jimmy Carter was president, we had little tussle with Iran. We were importing a lot of oil. We had a blockage. As a matter of fact, one of the guys who worked for me, well, two of them, went down to a gas station, and my buddy worked for me, took his gas lawnmower, and he stood in line with it at the gas station. And the other guy that worked for me took his picture. Now this has been seen. I've actually used it. If you look at my oil pitch from June 13th, 2015, which you find in our archive, and I'll reference at the end on a foil, you'll see a picture of that. So we had horrendous gas prices, there was rationing, and inflation got out of control. We had debt, war, lots of worries. We weren't handling the Middle East very well. And Paul Volcker, the Fed chair, said enough. And what he did is he raised the federal funds rate. I can't remember the exact number, but it was, it was, I'll just say, I was able to get a CD for 18% for 18 months. And ever since, the price of bonds has gone up as the yield went down. And now we're at the end of that cycle. We're beginning a new cycle. We're not going to go to where we were, but we had a tremendous boost. You could go with a 60-40, 60% equities, 40% fixed income, and make money on both sides. That trend is reversing now on the bond side. Now, it may be, and I've got some charts to show, excuse me, it may be that we hit a plateau. I'm hopeful of that, and then it'll be a good time to re-enter. But I'm hard pressed to see for the short term, meaning 6 months to 9 months, that you're going to make money in bonds. So let's look at some charts. Here's the 2-year U.S. Treasury. Look at the bottom chart. 1976. You see that big spike at the bottom chart, and how it is ramped down in terms of the rate over the years. And now at the end, you see it rising up. Well, that's the upper chart. 2 years versus 1976 forward. So as the rate goes up, the price declines. So when you buy a bond, you buy the price, you get the rate, and based on the discount or premium. You don't buy the rate, you buy the bond at a price. And it's the price that you need to pay attention to. So here's the 2-year. Here's international bonds. Here's what's happened over the last year on international bonds. They're a little longer duration. 8% down year to date. This is a 2-year plot of the iShares iGov. So as for me, I'll get into this in my tickers, but I have a way to beat the system. Now, this is a really key chart. If you got price on vertical axis, and you got duration, bond duration on the lower axis. And this shows you how much you stand to gain or lose as a function of the duration and time of a bond. So the rule of thumb is a duration of T in time will gain or lose a percent about equal to T. So example, bond's got a duration of 10 years and the rate moves up 1%, say from 2 to 3, it'll lose about 10% in the price. So you're gonna get a coupon payment in terms of interest, but you're gonna lose on the price. So if you're price sensitive to your holdings, you need to pay attention to this. This chart's in my 2018 marathon pitch of 3 hours. I found it on Zero Hedge and I published it several times. It's very useful. Okay, gold and metals, commodities are on the rise. I'm getting a little feedback here. First of all, I want to say that I'm very skeptical of the ability of all EV makers to secure battery material supply. EVs are the rage. VW, GM, Ford. Oh, there's a guy named Musk who runs Tesla. Musk has long-term contracts on nickel, on, I think, cobalt, on other things. And yesterday, no, it was Thursday, at his event, he said, I'm starting to think about lithium. And you know that if you're following the markets, you know he just bought almost 10% in Twitter, and now he's on the board. And he's going to shake things up. And yesterday he mentioned lithium and Albemarle. So if my feeling is everybody's converting over to EVs. And I think there's going to be a tremendous price increase of the raw materials. And unless they have long-term contracts, which I think Musk is the only one that's really got things locked up, they're not going to be able to provide EVs at a reasonable price. They either will suffer production constraints or they will be losing money for the prices they pay. So I highlight this because the world's changing from ICE, internal combustion engines, to EVs. So for EVs, my recommendation is I'm looking at materials and chargers, EVgo, ChargePoint, and Blink. And I'm waiting for a good entry point. And by the way, the US government is subsidizing them and it also attempting to subsidize and apply the DFA to materials. But we don't produce cobalt in the US. We have limited lithium in the US. Russia supplies an awful lot of nickel. So this is going to be a tough slog. So let me get into some other specifics. First of all, the commodities are pricey now and they're very vulnerable to headlines. So if there's a peace breakout, we'll see prices drop. Gold, silver, and copper. I'm a big fan of copper. Copper, there's, I think, 5 or 6 times the amount of copper in an EV versus a conventional car. I like the, my investment specifically in copper is in Freeport-McMoRan. and Southern copper, as opposed to the commodity. I should point out that commodities, if you want to invest in commodities, direct investment is done through contracts. You buy bushels of wheat or pork bellies or oil, and you should be aware that it's pretty pricey. And if you take the contract to its limit, you're obliged to take delivery. So if you want to buy oil as a commodity, you would end up with delivery of oil barrels in your driveway. So the way we invest as retail folks is through either an individual company or an ETF. And I've listed some here. GLD is a gold commodity play that can be had through an ETF, and there's actually a storehouse of gold. I think it's held in, well, it's held in secret. It's probably at the London Metal Exchange. SLV is a silver. I'm personally invested, as well as for the folks I invest for, in GDX. That's the gold miners. GDXJ is the junior miners, a little more volatile. NEM is Newmont Mining in Nevada primarily. PAS is Pan American Silver, and there's more. And again, I'm thinking copper is an ideal way to invest in EV vehicles. And Freeport-McMoRan, and again, Southern Copper in Peru are my choices. I've been in them for about a year. Base metals, the XME, ETF, lithium, there's an ETF, and Albemarle, and I just took a position in Albemarle. I've traded in and out before. The lithium ETF has exposure not only to, say, Albemarle, but Sequim and Chile, and China has a lot of lithium providers. So it's an international lithium ETF. And if there's going to be a huge demand, and the lithium is deposits are it's like a brine. You got a big salt area, and then it has to be processed. As far as rare earths, which are mostly in China, some in Russia, you got in the US, you have MP Materials, which is went bankrupt some years ago. It's been resurrected. And REMX is the ticker for the rare earth ETF. And the final point here is Russian exports blocked, nickel needed for steel, and palladium for catalytic converters. And I'm sure there's going to be some other surprises. Okay, my charts here, I picked up from my 2018 presentation in February. It was a 3-hour pitch, and I covered the waterfront. So they're illustrative and not current. What it shows you, these pie charts, there are different ways to invest in commodities through ETFs besides what I've already mentioned. These are diversified ETFs, DBA, DBC, Wisdom Tree, and I use Gunner, G-U-N-R. It's a trifecta. It's metals, agriculture, and energy all in one ETF. Done quite well. I discovered it from one of Jim Leventhal's compatriots on CNBC fairly recently. So it's already had a good run. Now, overall, think oils, grains, metals, coffee beans, cotton, they're producers. So it's hard goods, soft goods, and you'll see some of these in my tickers. Okay, I want to talk about volatility. We've had extreme volatility at times of stress. During the first year of the Trump administration, it was extraordinarily low. They were betting on tax rebates or a tax cut, which we got at the year-end 2017. Volatility went down to neighborhood of 10. And in the I think financial crisis, it peaked at I think 85 at one point. Now, volatility expresses the ups and downs of not only the S&P 500, which the see that caret, that if you look at your keyboard, look at the numeral 6, and above the numeral 6, you'll see the caret, upside down V, and that indicates it's an index. So an index, for example, S&P 500 is caret GSPC. So we don't invest in indexes or indices. We invest in a facsimile that attempts to replicate the index. And the primary difference is an expense ratio. So you want to keep your expense ratios low. That was Bogle's mantra, right? Passive, but low cost. Now, the problem with trying to replicate an index in the futures area, pardon me, which the volatility looks at, is based on options, and options have an expiration date, and as you go forward in time, the options decay. So if you look at the VXX, which attempts to replicate the index caret VIX for the S&P 500, it's decaying. Now, if you look at the blue line on the chart versus the index, the black line, you see it's miserable. You're losing money. Now, with futures, you only want to be in a derivative-based asset for a few days because it's decaying underneath. The underlying thing is decaying forward in time. Now, just at the bottom, I note that oil's got a VIX. It's caret OVX. It's a cousin. You can use it as a read on trader sentiment. There's other volatility measures. There's one on U.S. Treasuries, for example, and it was very stable a couple of years ago, and now it's it's popped up. So when you're in an ETF, be sure to understand what you're investing in. Okay, now we're going to a new section on the economy and more about investing. Any questions? Okay, I'll move forward. Thank you. Here's an estimate of US GDP actuals and estimates for 2021 and 2022. Now, last year, 2021, we ran at about a 6% GDP. And a 6% GDP is extremely healthy because the trend is 2 to 2.5% overall for a long period of time. And if you go into recession, what happens? Well, or a slowdown, well, GDP drops, slows down, may decay a bit, and therefore prices and company earnings will do the same. So in the next chart, I show the GDP now, which is the Atlanta Fed's real-time estimate of GDP. They're estimating that the first quarter of this year, which will be reported at the end of the month, is going to be down around 1%. Well, we're coming off 6%. And the shaded area in the graph is the blue chip economist consensus. And you can see that's dropping down. So that goes back to December, this graph. So it looks to me like we're going to take a dip in GDP. And if that's true, we're going to hear some earnings reports that may not be quite as favorable currently, and in particular, indicate a slowing economy. Now, most pundits forecast a very healthy year for the market. Here's the earnings and S&P year-end outlook tabulated by CNBC. Jim, I don't see yours on there. So the range is quite large. Now, the interesting thing is all these pundits have access to the same data. You know, it's public data, right? So we've got John Stoltzfus and Oppenheimer at 5330 year end. And we got Mike Wilson, Morgan Stanley at 4400. So what's the difference? Well, people look at different things. They have different views of how to interpret the data. So this is tricky business. It's a wide range. You know, that's not quite a 25% range in estimates. Everybody's got the same data. So where are we now? Well, we're at about 45.30 at the end of first quarter. The peak for the year was the first day of the year so far. So we're in a choppy point in time. The thing about time is we don't know the future. So what we have to do is trust but verify. You know, that was the Reagan slang. So we have to watch, do the best we can with what we know. But here's how you can do your own estimate. The chart on the right is from 2009. I had it in my 2018 pitch. You only have to know two things to forecast the year-end S&P 500 value, earnings, and a PE ratio. What's so hard about that? Well, what's hard about it is it's in the future. Now, the chart on the right shows the price history of S&P 500 for 10 years. And the year-end close was 47.66. So you can see we're a couple hundred points below that. And the dark line is the earnings estimate. Now, Jim and I have been reviewing each other's pitches, and he used Yardeni estimates, and I'm using FactSet, and they're remarkably close, within a couple bucks of each other at 227-ish. So let's consider the range to be 220 to 230. You know, there's going to be some wiggles in between. So if you're a real expert and you know where we'll be at year end, you're a genius. You just only have to know those two things: earnings and PE. And of course, what factors into that is sentiment. So here are the latest earnings estimates by quarter, which used to be easily available and from S&P. Silverblatt used to publish a spreadsheet, and you could readily see from one of the most respected guys in Wall Street what the earnings were, because he tabulated a lot of things that were publicly available, but they've taken that off, and it's all private now. I think he's part of S&P Global. So I consider this a set of great data, because I always have trouble finding quarterly estimates now. But Bob Pisani, who I highly respect on CNBC, straight arrow shooter, not a tricky guy, published these April 4th. And so out of this, you get an annual earnings estimate of 227, pretty close to FactSet and what Jim has. So a PE of 20 would give us a year end of 45.49 versus a year end of 45.16 plus an almost 2% dividend. So, but look at the PE ratio chart. You see it's all over the map. And the last few years, we've had what's called multiple expansion. In other words, you can see the PE ratio going up. That's multiple expansion. And we've got a tremendous number of unknowns. So there's really a wide range of outcomes. So my best advice is you keep your eye on the ball, you listen to earnings reports, you can go find them on the web. I've mentioned Home Depot before. You'll find out what's going on with the home builders by looking at the Home Depot guidance and commentary. Or you can look at Waste Management, one of my tickers, and it'll tell you about industrials, because they handle industrial waste. So there's a lot of information that can be gleaned for free. And of course, you can always go to Value Line. If you go to their 40-page report published weekly, they've got a great set of charts on companies with great free cash flow, discount to earnings, etc. So there's a lot of free information out there to help guide you through choppy periods. Now, I don't think we'll hit these numbers, but this chart's pretty key if we were in a high interest rate environment, what it says historically, you got PE on the left on the vertical axis, and you've got 10-year yield on the right. And this scatter chart, it indicates that you reach a point of saturation in the market with rates where as rates go up, you've got a healthy economy, right? But then you reach a point where maybe the Fed overdoes it and the market says that's too much. It's kind of like demand destruction. And the PE ratio will start to recede. So we'll see. We're not in the same environment as this graph illustrates. This is historical. I can't remember. Well, there's a lot of data points there, right? So there's a lot of years in this chart, but it indicates that if the Fed overdoes it, it'll push you into recession, and I'll talk about that next. So here we are on the Fed. The Fed controls the Fed funds rate, which is an overnight rate, provides regulatory functions over banks. Those are their two primary things. They actually do a lot more. They're politically independent, mostly. Right now, I'm not so sure that they're really that, they've got their eyes on the ball. Remember, we've had confirmation hearings for Powell, the Fed, who is now not the Fed chair, he's the pro temp. He's in limbo awaiting final confirmation. He's had his confirmation hearings. So is Lael Brainerd, the presumed vice chair. They're both Fed governors. They have 14-year terms, but the term as a Fed chair or a vice chair is 4 years. So I'm sure they're watching the markets and they're watching the political winds because they've got to be confirmed by the Senate, and that has not yet happened. Now, the Fed has 8 scheduled meetings a year, 4 with press conferences. Pardon me, that is an incorrect statement. They have a press conference every meeting. What they have 4 of is the dot plot. So I've got an error on that chart. So the Fed chairs we've had over the 30-year bond bull market is Volcker, Greenspan, Bernanke, and Yellen. And Volcker broke the back of inflation by raising rates so high that, like I said, CDs went to 16, 18%. The other voting members besides the governors are the presidents. The presidents, 4 rotate in and out every year. The current ones coming in are hawkish, and the Fed's very hawkish. And in between meetings, there are Fed minutes, and they all move markets now. This chart says, hey, we got to burn off $4.5 trillion of treasury and mortgage rates, agency rates on mortgages, and it'll take time. And hopefully it's primarily a runoff and not a sale. In other words, they'll let things mature and expire. So here's how they plan to do it. They leaked this out. It's not been voted on. We'll learn more at the May 4th meeting. Here's their meeting calendar. Right now, we've got 10 hikes priced in, and I would expect that we're going to get 50 basis point hikes. Here's their dot plot. You see, they do this every other meeting, and rates are going to go up, and then they forecast a decline. So we've got a potential for stagflation. We'll see. Here's the inflation chart overall, and then by used vehicles, energy, new vehicles, food, and shelter. That shelter is measured by rental equivalents to or housing equivalents in the form of rentals. So it's not really measuring house prices, it's measuring rents. That's the inflation picture. So QE to QT, it's an unwind and unfriendly to the markets. The yield curve is flattened. Now it just uninverted in the last couple of days, where the 10-year went back over the 2-year, but it's a indicator of the overall inflation and Fed stance. This is an important chart. Long duration versus short duration. I know we're running out of time, but I want to get through this. Long duration assets are stocks like Peloton, DocuSign, the stocks in the ARC ETF have earnings way down the road. They are priced high, their price to sales is high, and they've been severely punished. At some point, they're going to be tremendous values. Currently, what is really hanging in there, and what I'm focused on, is short duration assets. They pay dividends often, they have positive earnings, they're lower P ratios, they're defensive. These are the ones in favor, the ones that Jim spoke about, and I personally favor and am invested in. So market behavior, here's a track on, again, on sectors, and you should study that as you look for bargains, and hopefully you're holding on. So I see a witch's brew. We've got to be careful, but there are some great buys ahead. The trick is finding the bottom. It's impossible. So Jim's advice of dollar cost averaging is really excellent. I support that. I agree with that. And again, I suggest that forward look, pay attention to guidance. That's going to be what gets us through the year. Here's the Callan table, which Jim has a form that in this pitch, which is the Morningstar chart. Same idea, rotation, diversification. And here's my tickers. Now, I don't have time to go through all this. Let me give you a high-level summary, and I will take questions by email. You see that on the top, I've got a time scale. On the vertical axis, I've got what area they're in. I'm blessed with, well, I'm not young anymore. I've been investing since 1965, so I have some very long history with tickers. I was able to buy, I really went into some key areas in the early 90s, Microsoft, Applied Materials, Oracle. Prior to that, I had IBM, Entergy as a utility, and I picked up Walgreens, Procter and Gamble. All these have near zero cost basis. So I don't want to sell them. I'd have one heck of a tax bill. My Microsoft peaked at 13,000% return on investment. It's now probably about 10,000%. If I wanted to sell it, I'd have that big tax bill. So find good horses, ride them for a long time, let them compound, you'll be well rewarded. You can go through my tickers. If you got a question, feel free to send me an email. Any particular question at this time?
The first question was, do you think the Fed will end up raising as many times as the market is projecting this year?
I don't know. I think what they're going to do, I think they're going to hit us very hard with 50 basis point hikes. So I think that starting in May, we're going to hear some harsh rhetoric. Bill Dudley, the former New York Fed governor, said they should shock the market. Larry Summers, the next Treasury Secretary, basically said the same thing. So I think they're going to come out with guns blazing. And my opinion about the Fed is they really can't control inflation. And if you look at the causes, they can't do anything about COVID. They can't do anything about people returning to work. They can't do anything about the war. They can't affect supply chains. So I think they're going to be frustrated, and I think inflation will be persistent, and the Fed will react accordingly because they're not going to be able to control inflation for some period of time.
Jim's comment was that his target is 5,030. There was also, go ahead. There's also,
Go ahead.
there was also a question about your email, which I posted in the reply. So go ahead.
Email.
They asked for your
Oh,
email from the first slide,
It's on the front. It's on the front page.
and I also posted it.
Yeah.
Were you going to respond about Jim's statement of 5,030?
I love it.
The next question.
Time will tell. In IBM, I was known for my forecasting ability. I was highly prized and sought after by vice presidents from other areas. I'm not able to forecast it. What I do is I watch and adjust as the data tells me to.
Next question, what is the best index fund you would recommend at this point if we don't want individual stocks?
RSP. It's an equal weight S&P 500, and it takes out the vulnerability of the the high valued Silicon Valley stocks and Amazon, because they are targets of both Europe and Congress. So I would recommend the equal weight S&P 500. There's also a Russell 1000, it's called EQAL, equal weight Russell 1000 ETF out there. The only downside of that is it doesn't have very high volume. So you might get into if you want to sell it, you might lose a little bit on the bid-ask spread.
How much time do you spend managing your investments per week?
I manage money for myself, my family, and for others, a select group pro bono, meaning I don't charge, I'm not a professional. And frankly, I get up at 6:05 in the morning. I watch the market open. I'm on the market until 2 o'clock. during market days. And I multiplex, I do other things while I'm watching the market.
Do you think that the Japan Central Bank will stay on course as the only central bank printing money, especially if they start getting inflation?
They are not only printing money. Let me just say this: they have a huge demographic problem. Their population is aging, and they're in a tight spot. They've been actually investing in the U.S. in stocks as a way to keep them afloat. So I don't know, it's a long-term problem for them. Now, what they've been trying to do is manage to a 0.1% 10-year rate. And they have a variety of ways of doing that. Just as our Fed has an interest rate of 0.25 to 0.5 now that they've increased the rate, but they try to manage to 0.375, which is the mid-range. And there's a lot of sophisticated ways that they do that. And all central banks do that. But we'll see.
When you own a fast-growing stock, do you apply a cap, for instance, no more than 5% of your total portfolio, as far as what proportion it represents in your portfolio?
No, I don't. I let my winners run. The downside is if something goes south. I've got too much Microsoft, but to sell it with tremendous gains and near zero basis, California is a very unfriendly place for taxes. So I let my winners run. Now, what I do is I trade around in my taxable account, in my tax deferred accounts. That's where I do my primary trading. So it depends. It's taxable versus untaxed, tax deferred.
It also would make a difference if it was your employer, where you're also running the risk of, if something goes wrong, you could lose your job.
Well, I'm 14 years into retirement, so.
That's not a problem for you. That is true. Okay, one more question. What is your stop loss policy?
Actually, I watch it rather than, there's a risk in stop loss. And the risk is, if it's something I really want to hold on to, I'm willing to be patient, because if you look at Jim's great chart on the history of the market, unless you got a dog of a company, it's going to come back.
Okay, next question. Do we try to avoid the next bear market or just stay invested?
What I do is I trade around. As I indicated, I use my tax deferred accounts for trading primarily. As an example, in the 2008 crisis, market peaked, I think it was October 11th, 2007. Bernanke had already issued some warnings. I put that on my forehead and watched the market. When Bear Stearns went under on February 26, 2008, I said, that's it. I took all of my mutual funds, with the exception of commodity related, in my tax deferred accounts and went to cash. At the time, my IBM proprietary income fund was paying 5%. So I just put all that stuff in there. And I held on to my commodity driven accounts because the dollar was in a problem and China was building out for the Olympics. And I sold all that stuff on June 25th, 2008, 3 weeks before oil peaked at 135. And I rode out the rest of the year as best I could. So I didn't lose 40% in the market. I think I lost about 20% for the year. That's way better than losing 40%. So depends on the situation.
Okay, that's the last question that I see.
Okay, well, again, I'm happy to take questions by email, and thanks very much for your time. And I really appreciate Jim's time today. He's a wonderful guy and a great investor.
I want to thank our speakers. Bill, I think that was a terrific presentation and went down to the detail of actual ticker symbols and areas, and covered a very interesting subject in a very thorough way. So thanks very much, Bill, for that. I'd like to thank everyone who's helped on this program, Deborah and Celia, and all the board members. And I hope this has been useful to all of you. And we'll be back with the program in May. So I wish you all good luck, and we live in interesting times. So thank you very much.